Right. So over here, we started talking about the very basics of calculus, right? So we're talking about very fundamental calculus, and our objective over here was to introduce the different concepts of calculus that would be required for developing the market risk models in the next few sessions, right? So basically, what we talked about was the basic principles of limits, continuity, differentiability, functions, a function limit, continuity, differentiability. We talked about maxima, minima, and the after that, so we started talking. We also started talking. We started discussing about uh, you know about the basics of difference equations, differential equations. When do we need difference equations? When differential equations. We also talked about the concept of stochastic difference equation, right? Apart from that, we talked about how is it that a stochastic difference equation becomes important when we are trying to model market risk, right? Apart from that, we also started talking about different kinds of so we started talking about a differential equation as well, right? Now, when we started talking about the differential equations, and when we started talking about differential equations, we started using a very specific uh, differential equation, right, over here, which is nothing but which forms the very fundamental of the Black-Scholes-Merton model. So we started talking about the differential equation, which explains the dynamics of a price movement. Right. Now, what we saw in the last class was that what is it that makes a difference equation, stochastic in nature. So what makes it stochastic is the presence of the what should I say? So it is the presence of the error term, right? Which of the white noise error term, which makes it a more you know. So it is that which makes it uh, stochastic in nature. It's that white noise error term which makes all the difference. Now, what is the importance of this white noise error term? So the white noise is the error term which talks about. So when I say a white noise error term, I essentially refer to the fact that I essentially refer to the fact that yeah. So essentially, I kind of refer to the fact that it refers to the randomness of the time series that characterize the financial variables, right? So if I'm to talk about a financial variable like say an asset price movement, so what is it which determines the stochasticity or the uncertainty in the asset price movement? It is the white noise error term, right? So the white noise error term is nothing but it's a normally distributed variable, a variable which has a mean zero and a constant variance, right? So just before I move on, a very quick question. So while I talk about normal distribution or normally distributed with the mean and the variance, so are you guys clear with the concept of a normal distribution, or the Gaussian distribution or normal distribution? Why? What is the importance of this characterization of as a normal distribution? Why not any other distribution? So is this idea clear to us? So are you guys comfortable with the idea of a distribution, of a probability distribution with the idea of a normal distribution? Or if not, then what I can do is I can do a very quick summarization of this, because it's very important to understand the feature of a normal distribution. Otherwise, you would not be able to frame that particular idea, right? So
Yeah.
okay, so what I'll do is I'll do a very quick summarization. Perfect. So talking about distributions. So talking about the concept of distributions or probability distributions. So these are probability distributions helps us characterize or helps us picturize the likelihood of different values occurring within a variable, right? So let's say that I have a variable x, right, which is continuous in nature. So I say that the variable x belongs to minus infinity plus infinity, right? So if x belongs to minus infinity plus infinity, so x is a continuous variable, right? So now what are the probabilities of the different outcomes of this x to occur, right? So, so the relationship between the outcomes of a variable x and the probability of x. Right? So when we represent it through a mathematical relationship, so that is called a probability distribution function. So in a probability distribution function, on one side you have the x variable, and on the other side you have the probability of x variable. It gives us the likelihood of the outcomes of a variable, right? So, so if I'm to plot a distribution, right? So let me just plot it from here. So what you have over here is 0. Over here, what you have is the set of outcomes, which is x, and what we have over here is x. Right. So I have x, which is the outcome, and fx, which is the function which shows the probability of each outcome. Now, a typical probability distribution function would something look like this. Let's say that this is the regular distribution that we generally get to see. So now over here, so what does this? So this shows the way the outputs occur and what are the probability. And this is the point. You gradually goes there. So over here, what you can see is that I have created a relationship between the outcome x and the probability, right? And when I map this, I get the way the values, the likelihood of the respective outcomes to occur. And because this x is a continuous variable, the probability curve or the probability density function curve is continuous in nature. So this is a typical probability distribution. So it's a schedule which maps outcome to the probabilities. So it's a schedule which maps. So if you see, a probability distribution function is nothing but it's a schedule which shows how much or what are the probabilities of the respective outcomes are. So that is what a schedule is, right? Schedule mapping the outcomes to the probabilities. So it maps the outcomes to the probability. So outcomes to the probabilities. Right. Now a very specific type of a distribution is a normal distribution. A normal distribution or the Gaussian distribution is a kind of a benchmark distribution in in the domain of risk analytics, right? Now, especially in market risk, because whenever you want to, whenever you want to kind of identify randomness in the data, right, normal distributions play a very critical role. So over here, the next thing that we want to do is we want to understand what is it meant by the term normal distribution. The is the normal. So the normal distribution has some very specific characteristics which makes it a very strong distribution. Right. So this is where we need to understand what the normal distribution is. Right. Okay. So before we just start off, give me a minute's time. I'll just grab myself a bottle of water and I'll just be back. Give me a minute. Hey, hi guys. Can you hear me? Am I audible?
Yes, yes.
Okay. Fine. So as I was talking about normal distribution. Now, essentially, normal distribution as a probability distribution is not generally, this is not the true name of the distribution. The original name of the distribution was called Gaussian distribution. But given certain specific characteristics, right? It came to be called as a normal distribution. So this distribution that we have over here, so what are the characteristics of a normal distribution? And why is it that it becomes so important for any kind of, for especially, when you are trying to identify randomness, right? This distribution becomes absolutely indispensable. So let's look into this. Fine. So one of the biggest most important characteristic of a normal distribution is that you know it is a symmetric distribution, right? And given that it is a symmetric distribution, there are some characteristics which directly follows. So this is 0, this is x, this is fx. Okay, so this is a typical example of a normal distribution. So if you have a look into this distribution, you'll see that this distribution is a very symmetric distribution, right? Right. So over here, what we have is a right hand. So this side, so the right hand side and the left hand side is similar in terms of appearance. So it is absolutely symmetric in nature, right? So if you split this distribution in between, you'll see that the left hand and right hand side are absolutely identical in nature, right? So now what is the interpretation of this, or how do I interpret this for quantitative stuff? Now if I'm to a quantitative modeling, right, or so I would like to always want I would always want my sample to be normally distributed. Why? Because there is no element of skewness, right? So there is no undue concentration in any part of the distribution. So this distribution is purely a symmetric distribution. So I cannot distinguish the left hand side from the right hand side. So it means that, so what it means is that the median values or the middlemost values have the highest probabilities of occurring. So it's the representative of the average values or the more representative figures which will have the highest chances of occurring, unlike in a skewed distribution. So given that this distribution is a symmetric distribution, right, its mean, median, and mode are the same, right? So the mean equals to median equal to mode. Mu is the mean equals to the median equals to the mode, right? So it's mu equals to median equal to mode, right? So this is where we are. So this is why this this is one of the important characteristics of this distribution. Now, given that it does not have any skewed behavior, skewed concentration of observation one end, This distribution does away with one very basic problem. This distribution does not have any outliers. So if your variable is normally distributed, then you cannot have an outlier or some extreme observations into this distribution, right? So, so this is one another important characteristic of the distribution. Now, now given that this is a symmetric distribution, right? So all the observations are generally surrounded or they fluctuate within the mean value, right? Within so basically the variation or the overall variance or the standard deviation of this distribution is very low. So the standard deviation, the sigma, is very low for this distribution. Sigma is very low in this distribution. Not only that, the sigma is also constant value, right? So this distribution has a constant mean and a constant variance, and the sigma is relatively low. That is, the observations are concentrated or clubbed towards the mean, median, and are clubbed towards the central tendency measures, right? So if you have a look into this, right, so then let's say the mean of a variable or mean of a distribution is zero and it follows a normal distribution. So what does it imply? So if the mean of a distribution is zero, it means that all the values are either plus, either minuses, and they cut off, and the mean is totally zero, and the covariance is constant, right? So it means that the values are moving in equal amplitudes about the mean value. In other words, the distribution of the variable is random, right? So let's think about it in this way, right? Yeah. So let's kind of think about it in this way that uh, I have, say, a line over here. So this is the part where I'm trying to connect the symmetric distribution to the concept of uh, white noise. This is 0, so this is x, and this is over here. I have the probability associated with x, right? So over here, let's say this is the mean value, right? So I'll just put a straight line here. So the mean is 0. Now, over here, the first value is, let's say, it's plus 5. The second value, so given x equal to 2, the next value is minus 5, right? Now see that when x is equal to 1, right, this probability is say zero point 0.5, right? Or when this is this, it is minus zero point 0.5. So it's like this. Again, uh, let's not write it as a distribution over here. This is why. So the equation is such that when y equals to x is 1, let's say this is 5. When x is equal to 2, then if it had not been random, if it had a pattern, it would have been something more or less than 1, but in a similar pattern. When 1 is positive, in something with 2 it should be positive, right? Positive, downward coming, whatever, but it should be positive. But over here I get x equal to is -5. So over here 3 is 10 and 4 it's -10. The -10. Right. Now let's join these lines. 1, this is 2, this is 3, this is 4. So what you can see is that when, so about this, so this is +5 -5, right? So the sum is 0. +10 -10, the sum is 0. So the average of the mean is 0. So whenever I have I have a distribution, I have a set of values which are uniformly distributed or which are uniformly fluctuating about 0, right? So then it means that the movement is absolutely random. So for x equal to 1 it is 5, for 2 it's -5, 3 is 10, 4 is -10, 5 is -50, +15, 6 is -15. So it doesn't happen that way, right? So for 1 is 5, 3 is 10, 5 is 15, like this. It doesn't happen like that, right? So what we need to do is we need to, so if it is not random, we would require a consistent rule. So either it would monotonically increase or decrease. But over here you can see it's going up and down, up and down. So that means this is random, right? And when this happens, when it happens in equal mean amplitude, the mean is 0, right? But at the same time, if you observe, the variation over here is more or less constant. So this variation from here and here, or from here and here, right, is constant, right? So the variance remains constant. Therefore, if a random variable x follows a normal distribution which means 0 and a constant variance, then it means that that x variable is a random variable. So this variable is absolutely random in nature and it's a white noise variable, right? So that is what this error variable does, and it is this error variable which adds in the element of stochasticity in in this part of calculus, right? So it is in 0 comma sigma square e, right? So et follows in 0 sigma square e. So so if a variable follows this distribution, then that variable is a random variable, right? So now can we relate as to why am I saying that the random term or the white noise term follows a normal distribution? So how these two concepts correlate? Is this part clear to you? Any questions up to this part? Because this is a very important specification that we have.
You explained no the random variable means it follow this part. Just can you repeat once more? The random variable has two properties. So just can you just repeat it?
The random variables, I mean the random term or the normal distribution, which whose properties should do you want?
The random variable property.
Okay, okay. See, let's before I go to the property, right? Let's try to understand what is this random term. Why is it so important? Now, we always what we are doing. So there is always an observed set of values that we have, and there is always a estimated set of values, right? So the one that we estimate. Now, when we are predicting, right, be it credit risk, be it market risk, be it retail risk, whatever, whenever a prediction is going on, what is it that we are doing? what we are doing is we are trying to predict the behavior of a variable basis the historical average behavior. So that variable's behavior which we could see with our eyes, right? Or that historical behavior of a variable which we have already seen is something which we are trying basis which we are trying to predict the future. However, there are some factors which cannot be predicted, right? So standing today, can I predict that tomorrow there will be a flood? I can't, right? It's a random event. So these events they occur from anywhere. So they just come into the system from anywhere, right? And they create an element of randomness, and it is the existence of this error term which creates the difference between the observed and the predicted values. Now, if this error term was not there, had this error term been not there, then we would have had 100% deterministic systems, right? And in such a case, no prediction or no predictive modeling would be required. So even when we are trying to predict, when we are working in credit risk, we what we do is we try to predict the expected loss and the unexpected loss, right? But can we in any way can we say that okay, an event will occur tomorrow, or it is likely that an event will occur tomorrow which will create an unexpected loss? We can't, right? And that is why it's called unexpected. So whenever we are trying to predict something, so there is always this unknown factor involved into it, and which we cannot do anything about. So our objective is to make it as close as possible. So our objective over here is to make it as close as possible, right? So when we say it is we want to make it as or to take it as close as possible, so what are we doing over here? Or what are we saying? What we are trying to say over here is that what we are trying to say is that okay, if this wideness, this error term is there, how do I characterize that? Now, if it is random, right, so that means there would be no path to it. There will be no deterministic path to it. So it means that for if one value goes up, the next value it will go down. Again, in the next value it can go up. Again, in the next value it can go down. So it's random. It does not have any path. It may be that it goes up for 3 values and then goes down for the next 10 values. So, but it does not always have that. It is random to that extent that it can have any direction. It follows a Brownian motion. It follows it does not follow any logic. So it's absolutely white noise. It's a noise. It's not an information for us. So how do I characterize that kind of a system? So to characterize that kind of a system, I need first of all a symmetric distribution, right? That's why normal distribution. So what should be the mean of the distribution? Any positive value, negative value, 0. So it should ideally be 0. Why? Because if it's a random movement, then all the positive and the negative movements should be cancelled out, right?
Okay. All right.
Yeah. So that is the reason as to why we need the mean 0 and we need the variance sigma square, right? So that is why we define the white noise, define the random term with a mean 0 and a constant variance, right? And the reason why, so this is the reason. Now, this distribution is just a representative distribution just to show that the path that it moves about in a random manner. Clear?
Yes.
Okay. Okay. So just take 2 minutes time and go through this. Try to recollect the description that we have, the discussion that we have done just right now. right? If you have any questions, ask me, and then we'll move on to the next part. Yeah. So clear? Is this part clear? Perfect. Now, the next part that comes in here is that okay. So now we have understood this, right? So the wideness. Whenever we are trying to design in kind of random behavior, right? We are trying to we try to describe it using a normal distribution with mean zero and a constant variance. Now, Now from here, after discussing this, we have talked about the differential equations. So what is a differential equation? Now differential equation is very important for us at this stage because using differential equations we can kind of describe the dynamics of asset paths, right? And whenever we try to assess risk, it is important that we try to understand the dynamics of the path that a particular asset follows, right? So with that we tried so with that we started discussing the concept of differential equation in the last session, right? And when we started talking about that, we thought of discussing this in more in relevance to market risk factors, and we considered the asset price risk over here. So we'll talk about one particular part of a risk which we call the asset price risk. So what is an asset price risk and how does this risk come about? We know that banks, they, banks and financial institutions, right? What they do is they invest in multiple assets, right? So multiple assets which are traded in the stock exchange. So over there, so when we look into these kind of assets, so when we look into these kinds of assets, what happens is that this asset price risk, or in this asset price risk, so so when they invest in these assets are subject to the asset price risks, right? So when we talk about the asset price risk over there, so these assets, these investments are subjected to movements in asset prices, right? So basically, let's say I invest in as a so as an investment company or as a bank, what I do is I go ahead and I invest in a particular asset, right? I look into into the shares of a stock, and what happens is I see that the stock price goes up, right? It's going up, it's going up. And I know, okay, as it goes slightly up, I'll sell it off, I'll make a return, and then I'll invest it in another lower stock. Now, what happens is that suddenly there is a mean reverting behavior which is observed, and the asset prices crash, right? So if the asset prices crash, then all of a sudden the people who were there would lose out on their investments, right? So they would lose out on their investments, and not only that, they would so there would be a huge loss of a huge investment loss to the banks, because the banks invest in quite lump sum or quite a hefty amount in stocks and shares. Now, from this perspective, asset price risks are very important to assess. Like if we go back to the U.S. markets, right, quite a few years back, right, the beginning of the dot-com bubble in 1995-96, right, so which had peaked during that time, and then it had started, it slowly started deflating towards 2000, and then the market crashed, right. So what happened was that with the ID boom coming in, right? With different companies coming in place, like companies like Google, Amazon, and a whole set of other uh, other companies coming in. What happened was that many of these people, so many investors, many financial institutions started investing into those assets. The similar tendency was also seen last year when when the housing prices were rising, right? Uh, and many banks and financial institutions had invested in the specialized derivative assets which were issued by Lehman Brothers and other investment banks. So, so in such cases the challenges are that we without having an idea about what the values could be, whether it's fundamental, how deviated are the asset prices on the fundamental values, that they go and investors invest into that, and that causes a hell lot of a risk for the investors when the asset prices crash, right? So ultimately, at the end of the day, the objective over here is to help us understand how is it that we can frame the risk associated with the asset prices. So how is it we can identify an asset price trajectory, right? And where is it going? Where is it going to? So, with that particular objective, what we want to do is we need to understand what the asset price risk is. And to assess that, we need to understand how would the asset prices change. What are the factors which drives the asset prices to change, right? So over here, so let's say something like this. So the asset price movements look something like this. So this is 0, this is time, and over here what we have is the asset returns. Because investments in assets are dependent on the returns, right? So what was the price at which the asset was brought? The 1 unit of the asset was brought, and the price that is there at the present moment. So what is the percentage difference between the two? So that's the returns on the assets. So let's say that more or less there is a long run average asset price which is like this. Now what we get to see is the observed asset values, or now in the most recent past, that's what the asset prices look like is something like this. Right? So it goes up something like this. But after a point of time, right? So what I need to understand is, so where does the risk occur? So what happens is that as the asset prices keeps on increasing like this, so after a point of time, the price falls. Bang. So the asset price just crashes, and then it becomes something like this, and it even goes downwards. So what do you see to be here? So what it shows over here is that the asset prices have increased, and then it just crashed. So now the question is that if I want to if I want to assess the risks associated with the asset prices, say I'm buying an asset this time, right? And I know it's a very, uh, let's say I'm an IT investor. I'm an investor. I've been buying out shares of Google. I bought shares of Amazon, and I bought shares of a whole lot of new IT companies standing in 1996. And I'm trying to visualize my portfolio, like say 2 years down the line, 3 years down the line, how it is going to look like, right? So that's where I need to assess the risk, right? So one very common measure that we generally use is the value at risk. So over here, the way I'm going to talk about risk is slightly different than obviously, yes, will come down to VAR and all the other measures that are typically used. So basically, over here, let's say I'm a investor, right? So I'm Mr. Buffett, standing on 1996, and I have a lot of investments in these stocks, right? So now what happens is that I'm trying to understand that, okay, how is it that the asset prices would move, right? And what are the risks associated with it? So the easiest way for me to work out this is to find out what are the chances that the asset price is going to crash in the next 12 months, or let's say in the next DT period. So in the next continuous time period. So what is the probability that yes, this asset price will crash in the next 2 months, in the next say half an hour, in the next 50 minutes, so like this. So you can actually do it in a multiple period of time, in a very continuous period of time, and if you track that probability of crashing, right, you will see that that probability to crash is increasing at the neighborhood of this. Right. So when you see that the probability to crash is increasing gradually, right? When that metric gradually increases, then you know that yes, it's a chance. So there is a risk, and the asset needs to be traded off right now. So we are already high above the fundamentals. We're trading high above the fundamentals. I can now sell my asset off at a premium. I should just go ahead and sell it and not wait for further rises in the asset prices to happen, right? Okay, so so what I would do is I would just try to predict the probability of the borrowed of the asset price to crash, right, in the next, say, half an hour, next 1 hour, next 1 hour, 90 minutes, and like 50 minutes, so on, right. And when I know that okay, this indicator to crash is increasing, what I would go ahead and do is I would just sell off my asset. So I would not wait for it to go up further, right. So this is precisely what we want to this is precisely what we want to study next over here. That is the price dynamics. And when and because asset prices today, in today's market, it changes in the flick of a second, right. Therefore the movement of the asset prices over time happens, or the movement of the asset prices happen in continuous time, right. And that is where that is where we need the concept of differential equations. Maybe differential equations are not used to model the market risk, or would not be used for modeling market risk, but what it would help us understand is what should be the core, what should be the key equations that must be there, that we must have, so that the market risk models can be developed, so that the risks in different market instruments in asset prices can be assessed, right. So that is something that we want to next study, right. So is the explanation up to this point clear?
Yes, yes, Subra. Yes, Tanmay.
Okay, perfect. Fine. So let's try to understand. The first thing is that how is it a differential equation can be used in order to assess the asset prices? So how do we again connect them, right? So over here, we need to understand. Let's have a look into this movement of asset prices, right? So right. So over here, what we have is we have the asset price. Asset price, right. Now let's think about the asset price. Now an asset price is identified using two things. One is its average returns, right? And the second is the volatility. Now, this volatility is nothing but it's the standard deviation. It is nothing but it's the overall deviations that we have, right? So, when I talk about this particular thing, right? So, this asset price movement. So when I talk about this asset price movements over here, like mu A, sigma A, and all this. So basically, any asset price movement is designed by or is impacted by two things. Number one is the mean. The second is the volatility, the mean returns and the volatility, right? So let's say I have the mean returns. So let's do it like this. Yeah. So this is where the so this is the long run asset price or the average asset price. This is your new A. Okay, fine. Uh, so now let's see over here. So this is the asset movement that is happening. So over here, what we have is we have this particular framework, right? Now, one thing over here is that you see that this mean line, the mean returns line of the mean returns, is a fixed straight line, right? On the other hand, this is the so this deviation from the straight line is your sigma e or your standard deviation, right? So how do we define standard deviation? So the standard deviation of returns 1 by n 1 by n summation Ri minus R bar whole square, right? And then it is the whole root over. Right, so what I have over here is sigma A, which is 1 by n, summation Ri minus R bar whole square. So this is the standard, the average deviation of the return observation from its average return or from the mean returns, right? So this is precisely what we talk about. Now, if you have a look into the standard deviation is neither, it's not a fixed value, right? It's an average value, but the various deviations differ, right? So, along with this sigma A, there is something which is also which is not causing this sigma A to be fixed. So, it is there is certain variation, there is certain randomness in this fluctuation as well. So, there is some factor which is adding this sigma A to move, to fluctuate, to change, right? Now there is also, so that means because the sigma is the average value, but the other values are not like that. So that means the total volatility or the total movement in the DP is caused not only by the mean returns over time, but also this by the average value of the volatility over and all the concurrent changes in that average volatility. So all changes about that average dispersion is your volatility, right? So these are the two things. So first it would be the mean plus the up and down that is there about the mean at that point of time, which will determine what the rate of the change of the price is going to be, right? So therefore I need to incorporate a random variable. So we need to incorporate a random variable. So the question that comes out over here is that what is that random variable? That random variable is nothing but the random variable is the Weiner variable. So that random variable that we use over there is called the Weiner variable, Weiner process variable. So, so Umesh has a question over here. So is that the standard formula for Weiner variable? Yes, Umesh. So Weiner variable is a separate variable, right? Now the formula is, or the dynamics is of the changes in the asset price, or the returns dynamics. Right? So this random variable, the random variable that we are talking about is a Weiner process. So the next part we talk about is, we first talk about Weiner process, and then we'll talk about the role of Weiner process in designing a stochastic model. Right. So let's take a 5 minutes break, right? And then let's get started. So it's like 5:27 my time, right? So let's take a 10 minutes break and then get started, right? So we'll start at it's 5:30 now roughly. We start at 5:40, right? So I'll come when I come back. We'll talk about what Wiener process is, right, and how is it used in this asset price movement to replicate the asset price movements. So how is it done? What it is all about, right? So just give me 5 minutes time. Just go through it by till that time. We'll just come back and we'll resume. Thank you. Hey, hi guys. Hello. Tom there, Umesh there. Perfect. Perfect. Okay. Okay, guys, I just kind of wanted to ask you something. What's coming up to my mind really right now? Okay, I'll drop a mail when we connect back. Sorry. Perfect. Okay, fine. So, coming back to the part where we left it off. So, first of all, we were talking about the asset price movements, right? So let's start and let's see how these things they work in together. So before I start off, just hmm, so we'll just keep this as a reference, right? And I'll explain you what this Weiner process is. Hmm. Okay. So over here, let's have a look into this. So I have random variables. Yeah. Okay. So talking about the asset price part. So DP, as we talked about, uh, as we had discussed in the last class also. So DP represents the continuous change in price. Right? So DP is the change in price divided by P. So if I talk about the percentage is DP by P is nothing but it is the percentage change in price. This is the percentage change in price. And how do we define the percentage change in price for an asset? It is nothing but the returns from that asset, right? So dB by P is nothing but it's the continuous time volatility, right? So it talks about the percentage change in the price of an asset. What are the most determining factors behind this asset price or the percentage change in price? One of them is, so what are the most deciding factors? So one of the factors which determines this change in the price is your mu A, which is the mean of the asset price, right? Mu A, GT. So mu A is the mean of the asset price, the mean returns. So this mean returns is nothing but this continuous line. So the percentage change in price is impacted by the mean returns over a continuous period of time. Let's say it says that if the mean returns is rupees 10, right, at a given point of time, and if the time changes by 5 units, the returns to the asset is 50. So this is the percentage change in price is determined by the mean returns into the change in time, and that is a continuous change in time. So over here, the next thing that we talk about is the sigma A T, right? So it says that the percentage change in price is impacted by the mean returns from the asset mu A, dt, which is the change in time, plus sigma A. Sigma A is the volatility. Now I am saying that the movement in price is not only impacted by returns, but it is also impacted by volatility, right? Because when an investor is investing into an asset, he not only looks into the mean returns, but he also looks into the sigma. He also looks into the asset price. I mean, he also looks into the volatility of the asset. That is DWAT. Now, why this DWAT? So it says that sigma, this sigma that you are saying, it's an average figure, right? But there are randomness, or there are movements in the, or there are even changes in this variation. So how do I incorporate these changes? So what I'm saying is this change is you can incorporate this change by a random variable over here, a variable which is representing a Brownian motion, right? And that variable is nothing but the Weiner Wiener variable. Weiner variable, right? So what is this WAT? Why this WAT is over here? That's the question. So now this WAT is used, or the Weiner variable, the Weiner process Weiner variable is used to factor in this randomness in the movement. This increase sometimes called the increases. So this movement of the asset prices is used, or the, based on the volatility of the movement. So that is done by factoring in this Wiener process, right? So is this part clear to us? So now we'll talk about what is this Wiener variable. Now, Weiner variable is used, or it is also known as the Brownian motion variable, a variable which factors in the Brownian motion. So, what is Brownian motion? So, Brownian motion is a very, it's a very classic concept which was identified by Newton, right? Or Einstein, I don't remember. So, I think it was Newton, right? So, what he said is that that if you take a bowl of water, right, and you just sprinkle in some particles of powder into it, and you just turn the vessel in any direction, you see that no matter in which direction the water flows, the powder particles, number one, they float on water, and they move in different directions, and there is no specific pattern to that direction. And that is the reason why right? So that is why this Weiner variable was a mathematical replication or a mathematical formalization of the Brownian motion, right? Now, when I talk about this Brownian motion variable, so how does this make it the Brownian motion variable, or how does it replicate the Brownian motion? So that is something that we need to see over here. Right. So let's see how. So the question that comes out is that how is this Weiner variable uh, kind of a replication or a formalization of this Brownian motion? So let's read this more about this, right? So it says that it is a continuous time stochastic process WT with W0 equal to 0. So it says that at an initial point of time W0 is 0. So it starts from 0. So this is a very important specification of this Brownian motion, right? So it says that W0 is equal to 0, right? And this is for any t greater than equal to 0. Now, if there are two, there are two movements. I mean, like if there are two times, there's 2 point of time, right? And two mutual not interlapping time period. So one is a WT and the other is WS. So these are two time. So then the difference between these two, so WT minus WS, right? So this WT minus WS, so this increment, so this change, this increment is Gaussian. So that is normally distributed with mean 0 and a variance P minus S, right? So this says that, so this follows. So this is what? This is delta W, right? Now over here P and S are considered to have distinct differences, like we had for the difference equation. So the difference is discrete in nature. But if the difference is continuous in time, right, such that P and S differ by a very small number epsilon, where epsilon tends to 0, right? So then this delta W becomes dW. This is the Wiener variable for this variable for this, you know, P, comma T, right? So this is WT minus WS, which is delta W. Now it says that this delta W, or this change in the Wiener process, is, or these increments, the difference between WT and WS. So what has happened in W, and if I look into WS, right? Now again, if I look into the same interval of time somewhere else, the differences that I may get in terms of the values of W, that would be very different, right? So they do not follow any pattern. It says that this follows a normal distribution with mean 0 and variance P minus S, that is difference P minus S. Now S may be very small changes, right? Let's say S tends to 0, then it follows, uh, so dW over here will follow a normal distribution with a mean 0 and a standard deviation root t, because over here s will tend to 0. So this s is a very small value. So t, then t plus 0.00000001, then t plus 0.00000001, like this. So s can be infinitesimally small increments in time, and that is why this is dw, right? The change in the Weiner process, the increments in the Weiner process, and this increment is random, right? So sometimes therefore it is high, sometimes it is low, and this makes this asset price fluctuating in nature. This brings in the dynamism in the volatility value. Otherwise it would have been a sigma a. Sigma a would have been a constant value. So if there was constancy, if there was no randomness, then the asset price dynamics would be easily predictable. Yeah. So is this part clear now? Okay. So Umesh, you're confused. I understand. Where are you confused? Okay, fine. Let's go through it again. Okay. So just before I start, just tell me the following. So have you understood the concept of the Weiner process itself? This specification that I talked about, this part. Okay. Yeah, this part is a bit confusing, right? But this is the stochastic calculus part, and this is very important. It would be coming again and again as we go to talk about the modeling side of things, right? So this is the part from where this entire thing starts. So when we talk about option pricing, when we talk about derivative pricing, so all these things will be coming in again and again. So the Black-Scholes-Norton model. So this is a very critical part, and it's very important that you understand this concept very clearly, right? So let's go through this concept once again. Let's think about a fact, right? Think about the Nasdaq, right? Uh, so when we plot the volatility series, how does it look like? So is it a constant value? It's not, right? Let me see if I have a volatility data in my system. Just give me a minute, huh? I think I should have. Give me a moment. Yes, that's what I'm trying to do. So I'm just trying to like help you connect between these two concepts. So, okay. Just give me a minute, huh? Just let me find it out, because these data sets are like in quite some time I have had my hands on them. Okay. Let's say this is the Sensex data, right? So I have the open price, high, low, close prices, right? So let's do it something like this. So let me just compute the returns for this. And let me see what the discrete dimensional ratio is over here. So I have the data from 1991. to 2016. Right. Fine. So this is the returns. So returns is, so we'll use the closing price, right? This is G5 minus G4 by G4. Okay, right. So let's have it like this. So now, if you see this series that I have plotted, or that I have that I have created over here, right? So I have minus 1.69, I have my 2.89, then minus zero point 0.2 to 2.56. You see that so if I plot this on the graph, right? On a graph, if I plot this one, so what will you see over here? Basically, you see that these prices have kept on moving, right? So this is what the returns are. So let's plot this graph first. Fine. So I have the select data, returns. So just let me plot this. Right. So this is how your volatility series would look like. Right. So now what I want to do is I want to plot a mean returns over here. Right. So I'll add a trend line over here. Let me put a linear line. Right. Hmm. So over here, what you can see is that this is the linear trend line, right? So this is the average return. This is a line of average return that we have. So and this is slightly over zero, right? So what you see is that this is some point, some percentage, something like that, right? So over here, you have some positive values, you have some negative values. It goes on like this. Now, now observe these spikes. So basically, if I want to find out the return, the return dynamic, the dynamics of the return variable, I would not only use this mean value, right? I would also use a value which is so I'd also use a value which not only reflects the mean returns but which also reflects the volatility or the fluctuations from the mean returns. Now if you look into this distribution, obviously you will get a mean and you will also get a standard deviation, but that standard deviation would be a fixed value, right? So apart from all these deviations, it will give you the average values. But over here, observe that there are some very high peaks which has happened, and then there are some very low peaks which has happened, right? So what is this? I mean, so what is there which causes these movements? So these are not at all. What should I say? These are not at all at a constant height, right? If you see here, there are certain clusterings, there are certain spikes, there are certain downward spikes, and so on. So you have all these movements, right? So that means to that average value, there is something which is causing a randomness in the movements, right? So in these peaks, so if you try to join them, you will not get a uniform straight line because these peaks are of different levels, right? So what is that which contains? So if I need to represent that mathematically, how do I do that? What I need to do is I need to generate that. What I would do is I would uh, kind of so what I would do is I would kind of uh, take that and I would so basically with that sigma a, I would put in some kind of a random factor, right, to create that randomness. So let's see how that randomness can be created and what is that randomness. How is that randomness created? That randomness is created using a variable called the Weiner variable, right? So let's do something. Let's take this return series, right, and let's do some data analysis on this. Okay, so can you hear me now?
Yes, yes.
Okay, fine. So over here, what I'm doing is, so I've computed the mean and I've computed the standard deviation. So this is nothing but equal to your mu a and sigma a, right? Now over here, since the gap between each of the time period is 1 day, right? So therefore, I'll say that it is your dt is always one. So this is one. Okay, fine. So now let me just replicate the returns series. Or so over here, what I have is the Weiner variable. Hmm. So this is normally distributed. Right. So now observe that this Weiner variable is what? The Weiner variable is a variable which is So which follows a normal distribution with 0 and a root t minus s. So what I'm saying is that okay, fine. So s is, so since s is 1, so we'll just do it at with root t, because when s is infinitesimally small number, s tends to 0. So then it follows a normal distribution with mean 0 and root t. So now I'll just try to put in the returns part. So this Weiner variable may need some refinement, but over here you will get an idea as to how this thing can actually happen, right? So it's mean star dw, which is dt, which is 1, right? Plus sigma star the Weiner variable. Now out of this, the mean is fixed. The is fixed. So this alpha. So now if I let this be returns underscore month. So if you have a look into this, you see that. Just a moment, huh? I'll just check something over here. Sure, sure. Now it's coming. See, so now when I'm simulating this, when I'm trying to simulate this minor process over here, right? So what is this variable that it is coming up, right? So you can see that yes, it may not shoot the exact peak, but more or less whatever the values are coming up, you can see that yes, that volatility series is being replicated by this Weiner process, right? So why is this Weiner process over here? Because this adds this randomness to this fluctuations, right? So given the mean, given the standard deviation, right, and with this Wiener process in place, you can actually simulate the movement of a stock price. So this is your geometric Brownian motion. So wherever there are peaks, these huge spikes that have happened here and there, so those are not replicable over here, but more or less the average behavior of the movement is replicable by this Wiener process. So now is this idea Wiener process clear? So did you get this example? Tom, Umesh, both?
Okay, you mean to say that the wider variable adds randomness to the return quotient,
Correct. So basically, not only that, it
more randomness.
yes, yeah. So
Right?
it brings about that. So basically, the fact that the volatilities fluctuate over a time, right? So that is incorporated
Okay.
using this Wiener
In,
process, or this not the process, but I
okay.
would say the Wiener variable, and this is
Okay.
how it actually happens.
And this formula for this wider variable, means it is like predefined, or
Yeah, it's
we are
predefined. It's predefined.
it's predefined. Okay.
Yeah. Okay. So Umesh is a question over here that what is the Weiner values telling us in our Excel? So in our Excel, Weiner values do not tell you anything over here. They are not used for predictions. They are there to bring in, or they are incorporated to bring in the randomness or the Brownian motion in the system. Right now, like white noise, you cannot predict Brownian motions, right? So you are incorporating them in order to bring in a stochasticity to your system, right? Now it is this stochasticity which will, now by minimizing this stochasticity in your problem, you will be able to make the prediction, right? So by minimizing that stochasticity, you will be able to identify the path of the asset price, or the volatility in the system, the volatility structure, the underlying stochasticity. So those will be identified by Weiner process. Weiner process are not prediction variables. You cannot predict a Weiner process. That's why it's Brownian motion. So what one thing that we can see is, so this variable is helping us simulate that randomness, or that stochasticity which is there in the in the volatility structure of this particular asset price path, right? Perfect. So let's take a pause here for the day, right? I am uploading this recording and the last week's recording to the Google Drive today, so you can access them from tomorrow, right? So go through these four recordings, and from the next class onwards, we will be bringing in. We'll look into the we'll look into this part, and then we'll be moving on to the financial derivatives, and so from here we'll be moving towards the market risk part, right? So we'll be talking about instruments. We'll be talking about the different market instruments that are there in which investments happen. How do investments happen? How are they priced, and so on. So next week onwards, we'll be moving towards that side, right? So just go through these four recordings that we have completed, and from there we'll take it up next week. Thank you. Yes, so there are texts.
Thank you. Thank you, Sumit.
Yeah, so there are texts on Brownian motion. I'll share the name with you over mail. Thank
Okay.
you.
Okay.